Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Yeah, here's your host. Welcome to Cycles TV. My name is Lars von Thienen, and as always, once a week, Monday, same place, same time we meet here. I'm back up again. Last week I was taken down, but anyhow, and now I'm back. It's good to talk to you again. The chat section is on, so fire up your questions. As always, if you want, today we have a special subject. We need to talk on the European markets. Yes, we need. It was requested by a lot of community members anyhow, so the US markets are closed today. Then let's just use the time today to talk on the European markets. But before doing that, believe me, we have something to celebrate here. And this celebration is also a thank you to you as our watchers, community members, being so consistent here on the channel, because we have passed the 10K. Yes, the 10K, can't believe it, the 10K mark of our subscribers here to that channel, right? You see it. I hope you see it. So really a big thank you, so that we have now really passed the 10K mark. Yes. Thanks goes out to you. Continue to subscribe. Inform your friends. Like. Do a comment below the video. The next goal is let's reach out to the 100K. 100K is the next goal. I rely on you. Stay consistent. Stay with us. It was really a big journey from 0 to 10K here, beginning that channel. So a big thank you. Let's get growing here. So I think cycles education is interesting to everyone. Yeah, so let's jump into the European markets. I just pre-checked and we have something interesting to discuss here. Let's fire up the cycle analysis, right? Okay, so let's start with the Euro Stoxx 600 weekly, which gives us an interesting picture. Here is the chart. We are close to reaching we have reached a new all-time high for the European markets. Very interesting to see this here on the chart. Let's now discuss the cycles. I have anchored the starting point for that cycle analysis to the kilo 2003, which is, by the way, exactly the amount which I would recommend in most cases, so around 1,000 data points, 1,000 weeks. Anchored here to the key low, right? Okay, if we look down to the spectrum, there are two interesting cycles I would like to highlight for that discussion. The first one is around 193 weeks in that section. It's interesting for more than just one reason. I mean, the first, it's clear it stands out in the spectrum. It has a big triangle, which means it has a high strength. It is green, so it's a high bar-tail score. And it is selected, it has a circle around, so it is selected by our artificial intelligence to give us a kind of co-pilot in the cycle analysis. So that's the first one to go. The key reason why I mentioned 193 weeks is interesting. You might remember that the 40 or 41, 42 months cycle is interesting in the international financial markets. So if you do the math, you will certainly find that 190 weeks is close to the 41 months cycle, which is a long-term historical important cycle. It varies slightly around if you go down to calendar weeks, but it's quite visible. So we know that the 40-month cycle is there if you analyze 100 years or even more. I think 150 years of stock market data. So that is an important cycle. And by just using the last important 1000 weeks, it's still shown as the most dominant cycle. So that's interesting here. So let's use this as a starting one here. So and then I will walk you through the story. So let's have a closer look at that. You see here the alignment of tops and bottoms is close to what happened in the markets here, this low, and that's the current situation here, whereas a lot of room for that upswing leg of that cycle to continue for the European markets. However, let's make this analysis a little bit more comprehensive by adding the second important cycle for these European long-term analysis, which is, by the way, the Copilot gives us this as the most dominant important one, so ranking at the score of 1, which is the length of 145 weeks. It's shown here in the spectrum at this smaller peak here. So it's a clear, nice, and sharp peak, and also the strength, the Bartel score, and the amplitude looks nice here. So this is the second one, which is showing up here in the list. And let's first deselect the 193, and let's have just a look at the 145 weeks, which is just first cross-reference here, aligning key swings in that market also works. So even that low is better aligned here. So, and now we have two, they are not the same cycles, 190, 145 weeks. It's quite interesting. So let's build a composite and let's discuss these two cycles here. Let's have first a look. The outlook, just using that cycle, is also positive into summer this year. So if we're just interested, let's say for the next 3 to 4 or maybe 3 to 6 months, also this cycle is positive. The other one was anyhow very, very much positive for a longer period in time. So the short-term assumption, regardless which cycle we pick, is a positive outlook into the summer of that year for the European market. The picture gets now more interesting if we combine these two cycles. So this means the upswing of these combined cycles now might come to an end here at that point. This is the composite selection, and the composite selection might run out of energy by the end of this year. So quite a positive outlook by just using the combination of these two cycles. If you go back more into the history of these two cycles, it's interesting, and let me walk you through the story of these two cycles here, because they tell us a lot. So by just cross-checking the swings, by just connecting the bottoms and tops here, you see that after 2012, that cycle slightly, or at least after that point, comes out of tune. So I would assume that this top here shifted to that point, while this low shifted somewhere here, top. This top shifted slightly here, so you can skew, at least during this period here, 2014 to 2018, which will then result into this kind of swing. And then it extended here again into that mood. So, and if we then continue from here, we have it back in sync. That's a very rough drawing here, but you see that during the period of 2014 to 2018, this cycle was stretched or even combined with something else. And if you just look at that period with the cycle of 193, if you remember the period exactly between 2014 and 19, you see that during this time here, where it looked like the shorter one was out of sync, this 193-week cycle was clearly the main cycle during that period. Sorry, to make that clear. So this is why I think these two cycles play an important role, also looking separately at these cycles. So before 2014 and 18, the 145-week cycle was very prominent, or even more dominant than the 190 cycle. And afterwards, both come into alignment now. So the key rhythm of the European market seems to sync or switch or move between these two key cycles, 145 weeks, 193 weeks, just analyzing past 20, 25 years of data. And now, and this is also a request which I've often heard, we could plot both cycles individually on the chart, and not only the composite. So let's look at both cycles now in parallel on that chart. And in order to do that, if you use these tools, you can do this on your own. So you can activate let's start with the 145-week cycle. If you then go to the extended menu, there is the option to save a composite. This will allow you to store and save the current composite you have on the chart and to recall that composite later on any other chart. So I have saved this composite now, which is just one cycle with a length of 145 weeks. Once we've done that, we can now load that 154 composite cycle, because this is now possible by clicking this hamburger icon, go to data sources, switch to the composite here, where all your saved composite models are available for recall. And you see here we find the Stoxx 600. So this is just the composite I've saved with the 145-week cycle. And I will now load that composite model on the chart here to the left. So you see now in this blue-purple color design is now just the 145-week cycle. I can also activate this here and you will see the overlay. It's exactly the same. So we have now plotted that cycle as isolated single cycle on the screen. And now to see both cycles in action, let's now activate the 193-week cycle. And now you see both single cycles on one screen. And now you can even have a more complex analysis what's happening here. So for example, you see when both cycles are currently in sync. So here you have the exact low of the 145-week cycle and the low of the 193-week cycle. And you see what happened to a price at that point in time. So it was what's happening here on my chart here? It was a close down to this point here. And you see exactly the same behavior as the tops of the cycle aligned at the end of 2021. Where both cycles formed that top. We had the big uprun during that timing period here, where both phases of the cycle, between beginning of 2020 until end of 2021, both cycles of these two cycles have been in their same phase. So which had this huge upswing we saw in that market during that point in time. And you also have, and you also can go back here into the year of 2007, 2008, where we had this key top in these markets, and then running this more or less this crash into 2009, where we had the alignment of both cycle downward phases from July 2007 running into 2009. And you see the impact, what happens to price when these two cycles seem to be in sync with their phase and their key down or upward projection. So I think that makes the analysis of these two cycles shown as single cycles very interesting. For sure, it's not always that they are in sync with their tops and lows. In between, they go off sync, as we also see here in the past. And you can also see the behavior when we see this in sync. And when you analyze the periods when they are more or less out of phase, so they neutralize each other, which is here, you see we have a long sideways movement. So here a period over 1 year, where you see that this cycle was topping, this cycle was bottoming. So we just, and price was just sideways movement. So it's also interesting now to analyze really these segments, when they align, when they not align, and what you see in price movements during these periods of time here. For sure, you have then something in between. Let's move forward. So now let's come to the current situation, and I mean, that's the point why we are here. So we don't have that much beautiful analysis. So we passed the key sync of both cycles top here back at the end of 2021. But now, and this is what I want to bring to your attention, I think what is interesting. So the first key low we saw on the markets here, September, October 2022, which is here, is really in sync with this shorter term cycle. The secondary low we saw here now, we saw here in October 2023 is related to that cycle, and this is related to that cycle. So we can really see both cycle bottoms in these markets here. And again, this huge upswing momentum since then, you see, is one argument could be, so this, since this point in time here, so October last year, let's clear this up. So since October last year, both cycles, at least until this point in time here, are now into their upswing phase of both cycles. So the short-term cycle and the long-term cycle is in this upswing phase alignment. This is at least one explanation why we saw this huge uninterrupted, I think it was the strongest up move since 40 years maybe, not sure. So the strongest up move in counting just weeks, but regardless of that. So I think interesting is now this will continue, and that's why we are here. This seems to continue until, just reading the number here, quite to the point. It's, what is it here? It's May, end of May, June, will roll over to June. So these two cycles stay in sync until May, June this year, which means the reading of these two long-term cycles for the European market stays positive into summer this year. After that point in time, it really gets a complex beast, because then you see we have the misalignment of both cycles, starting end of 2024. Then the both cycles are completely the opposite, which, I mean, it could resolve in a longer sideways. Maybe one cycle overrules the other with a small correction, but at least it's not finally clear. We will then have a longer period of really, two different cycles being out of sync from their individual perspective. But at least, and that's why we're here, we should always reassess the situation. These two cycles, at least they explain more or less the past 20 years just by using these two cycles. And this situation, this regime continues into the summer period of that year. So we need to align our technical indicators here. I have now here added the cycle swing, the cyclic RSI. You see it has still some room to continue to the upside. So from a technical perspective, what I would look out for is the cyclic RSI maybe moving above the line, maybe forming a divergence here, and then maybe starting to roll back into the channel again. And if this is in alignment with somewhere here, the timing of early summer, that would be a perfect combination seeing the technical price indicator aligning with the time cycles. That is the European Stoxx. And now, just to complete the European picture, we could and we will jump to individual European countries. And for sure, we will jump to my home country, Germany. So what we're now looking for is the German DAX, Deutscher Aktienindex, the German DAX, long-term perspective. Let's do the same with that. What a beautiful upswing here since the year of 2009, by the way. So even stronger during the last period, even stronger than the US markets. But that's not the topic for discussion here. We are using weekly data. Let's have a look at the spectrum. And again, that's not daily, that's weekly. Again, 180 weeks, similar to the 40 months cycle, which I always find very interesting and fascinating. And I mean, this spectrum here, there's no discussion which cycle to pick, right? So I don't see any reason to pick any other cycle. And just counting the also our co-pilot or artificial support here clearly picks that cycle out of all possible peaks in that spectrum. So let's run that analysis. I mean, I see that visually, but it's a quite perfect match. Let's maybe discuss one topic here. So cycle analysis is always an analysis of the detrended signal. So what we see here clear is one constant uptrend. Yeah. So this red line would be the trend, and the cycle analyzed is by using the detrended version. So making that trend vertical, not horizontal. And then analyzing just the swings around that upsloping curve here, which is exactly that cyclic curve you would see here. And this is the cycle analysis we see here, just detrended, right? So that is exactly what I clearly see visually, but maybe it helps you, and this is a good example to also see what is meant by using a detrended cycle analysis, because this is a pretty perfect example why you just see the cycle is always detrended, and if you add the trend, it would exactly look like the red curve here. So this is just why I wanted to highlight that. We could also show the detrended version here, which shows you exactly that, but it won't help us here. So, okay, that's just an additional comment. I think this 170-week cycle is, I mean, we have a very strong uptrend. So in that very strong uptrend, it's not by surprise that the downswings are always smaller than the upswings. Yeah, so small downtrend, huge upswing, small downtrend, huge upswing, small downtrend, huge upswing, small downtrend, huge upswing, small downtrend, huge upswing. Yeah, so that's what you see here. So you need to take this into account if you project this cycle into the future. So we still have a larger underlying strong uptrend besides just analyzing this 176 week cycle here. So let's have now a closer look into what this tells us. Looking into this year and just zooming in. And now this analysis really gets interesting here if you combine this with the Euro Stoxx. So just analyzing the Deutsche Aktienindex, so the German DAX index, is also projecting the upswing leg of this long-term cycle to continue into, I mean, here we have September, but I would count just before that we discussed it's somewhere May, June, so summer this year. It seems like that also this upswing cycle might continue to the upside. So there's still room to go to the upside from the cyclic RSI indicator. It's the same here. So There's no sell signal yet issued by that. So the signal would be issued once we cross below, which happened the first time in June 2021. And then so this have been the crossing. So here was the first buy signal, and then the second one here. So this was the positive, where we had the confirmation of the left translation by that cycle, by that indicator here. But we now need to wait for the technical indicator to get above this band and then cross down below, which from a timing perspective is expected maybe to happen this summer here. So that's the perspective on the European markets. And quite interesting. I think the European Stoxx 600 analysis was quite comprehensive, because I like these two cycles, 146 weeks and 193 weeks. And if you analyze both cycles, you really see a pattern, between these cycles, what happens in the markets. They are still in alignment until May, June. So still positive cyclic energy in the European markets. Also confirmed just analyzing the German part of the European Union, where the long-term cycle is also visible, showing the picture into September here. So that's it for the European market. Quite a clear picture. And a huge uptrend still in the continuation. So let's now put some attention on your questions. So I will now switch over and try to get your questions sorted. So give me a second to bring that up. So Elliot, you brought up the question regarding running slope difference t-test and the cycles change completely. So we need to talk. The running slope difference test is something very special, and I would count it in a beta stage or beta phase yet. So let me share the screen and maybe maybe also explain to everyone what is. It seems like I have skewed up the chart here. Okay, let's try that. Okay, let's use that here. So this is the DAX, but it doesn't matter which one we pick here. Let me just explain what is the running slope difference test here. The running slope difference test is used for detecting important trend changes. So if you just activate the first switch, nothing should change from the cycle analysis. So maybe that's the key point, Elliot. I would first always only recommend to activate the RSD just to show the trend series only, because that's the main perspective of using the RSD. That's now the green lines here, and the green lines are calculated just by detecting important trend changes. So when the line changes, this means that in the markets, that's the point in time where the important trend changed in the past. And the key purpose of using that, so the key purpose of the RSD, and this should by no means change anything in the cycle analysis. You should look out for cycle analysis when the cyclic turns are in alignment with the indicated RSD change in trend points in time. So then you know that you have a quite good analysis of that cycle if these are in alignment with the projection here. So that's the purpose of the RSD. And you see even that these two, so here is a low, which is a low here, and here is a low. So that was a good one, and that was, so this is just changing from an uptrend into an even stronger uptrend, which means that this low here is valid regarding that trend. So the purpose of the RSD is to confirm cycles in the asset you analyze. And what is very experimental, and I think you have used that, is the second switch to use the RSD trend for the cycle scanner. This means you will not use the raw price, and I would recommend not to do this. This is only for research purposes. This will, instead of price, use the green line to detect cycles. And that's for sure. Then the cycle analysis will completely change, but you're just pushing in some kind of linear data into the cycle analyzer. And this really often makes no sense. So if you work with the RSD, running slope difference test, don't use the second switch here. It's too experimental. Use just the first one to confirm turns in the cycle with the major turns detected by the RSD. That's the purpose of using that feature. Adrian, during bull or bear markets, price and cycles often don't correlate at all. Can you explain this behavior and tell us how to deal with it when trading a cycle? Yeah, let's talk for a moment on that. Adrian, I think the key to detect first if you are in a bull or in a bear market is the longer time frame you're analyzing. That's why I often use weekly and daily, or even monthly, weekly, daily. So if on monthly, weekly data you identify you're in an upswing, I would count that on the next shorter time frame. So on the daily, then you are in a bull cycle, which means downswing in that longer weekly up or bull market would not be seen as a downtrend in the price series. So during a bull market, which you could identify by using the higher time frames, will result in a shorter term cycle downswing, maybe just to pause the upswing. So maybe just the momentum will go down and the market will not rise or continue to rise while you have that shorter downswing cycle. So, and then when the shorter term cycle aligns into an upswing, which is in alignment with the bull cycle, then you maybe see an even higher momentum in that markets. So that's, Adrian, how I would combine bull or bear scenarios from a longer term perspective with shorter term cycles. So, and same for the bear markets. So if you have a larger time frame, so the weekly and monthly is showing you and that you're still in a downswing, then each upswing cycle of that shorter time frame might just result in a pause of the downswing or even reducing the downward momentum. So that's how you might see cycles within bull or bear markets. So you will never see the single cycle as shown by the theoretical cycle on its own. You always need to bring them into context, like I showed you with the German DAX, where you have this upswing, which is a bull market, and that's then how to read the individual cycle swings. Shahid Yusuf, do we apply skew factor to daily and intraday analysis of single stocks? It's a good question. So the cycle skew is a feature which you can use, which means that in general, you will never see perfect symmetric cycles. And that's just by design. And this is also analyzed by a lot of scientific analysis. So let's bring in the cycle again. So this is a theoretical asymmetric cycle. So and asymmetric means the duration from top to the low is exactly the same amount of time which it takes then from the bottom to the top. This is a perfect symmetric cycle. In real life, you will never see these perfect symmetry happen. So therefore, you can apply so-called cycle skew factor, which is more applying for what happens in reality. And the standard assumption of cycles in financial markets is that the overall cycle length here is the same. So the duration from top to top and the duration from bottom to bottom, in that case, is always 176 weeks. So the overall cycle duration has not changed. But you can see now the time from the top to the bottom is shorter than the amount of time from the bottom to the top here. So, and this is called an asymmetric cycle, which is taken into account by the skew factor. And this is mainly on longer term cycles, so on weekly data. If you deal with financial data sets, weekly data, long-term analysis, then I would recommend turn on the skew factor, because this is a proven scientific analysis that long-term financial markets have a shorter period in that cycle when the downward phase happens, and the upward phase of that cycle always takes longer than the downward swing. This is researched by different analysts, and you can apply that to the cycle. You see it even perfectly aligns to using that cycle. It even gets a much better fit to the price behavior here. It's more for the advanced cycle analysis, so I don't always use it in the standard procedure here on the channel. But back to your question. Back to your question. Should we use this on daily and intraday for single stocks? And here my answer is no, especially not intraday. We have no evidence that this skew is at least a constant factor on intraday analysis. I mean, you will never see perfect symmetric cycles, but I would not recommend to turn on the skew factor on intraday, even not on daily. So if you want to use the skew, only use it on weekly or even longer. You can also use it on monthly. Maybe daily is, I would say it's in between, but not intraday. Okay, Shahid? Yeah, Trading Queen, you're welcome for sure. Yes, Andrea. I think the RSD is a really experimental new feature. So be careful with using that, and we need to spend more time also in a working group to analyze it. And yes, the RSD trend is just changing after the fact. So you cannot use it to derive the current trend, because it will change too late to get projection value out of it. It's just used to confirm turning points in the past. Nothing more, nothing more than that. So don't use it to derive any projections from the RSD per se. Yeah, so I think these are at least most of your key questions. And maybe let's just end the session with celebrating a little bit what we have achieved here. So again, I would say thank you for helping us reaching the 10K mark now on this Cycles TV channel. You are part of that. We made that happen. So really a big thank you. And please continue recommending, continue watching regular. I will be here every week for you to push the Cycles education, take your questions. Let's have learning journey here all together. And therefore, this was a special on the European markets. So I hope to see you next week, Monday, same time, same place. And as always, I love to be live with you. So please bring every colleague in so that we get more and more people here so we can grow the community. Thank you. Have a nice